Most people in the US earn a living through conventional jobs. They receive a paycheck and are required to pay income taxes. However, the top 1% of earners get most of their wealth from the stock market and real estate investments. Capital gains are taxed on those investments. The top capital gains tax rate is just 20% compared to the top federal income tax rate of 37%. Because of this, Warren Buffett, one of the wealthiest persons in America, frequently claims to pay fewer taxes than his secretary. So in this video, we will talk about 10 proven tax hacks used by millionaires to maximize their wealth. The video will be amazing, so stick to the end. Number 10. Depreciation. Depreciation is the term used to describe the gradual decline in the value of a corporate asset. For example, business equipment such as machinery loses its value over time as it ages. If you have a rental property, depreciation can also occur when you make improvements that stay useful for several years, such as replacing a roof. Wealthy people who own businesses or rental properties can deduct depreciation. Unfortunately, this is a tax saving you can take advantage of only if you own a rental property or a business with qualifying equipment. There are numerous methods of calculating what this deduction is worth, but the simplest is the straight line method, which allows you to calculate your deduction. This gives you the annual depreciation expense you can deduct when you file your federal taxes. Number 9. Gift to charity. Millionaires also have access to considerably larger deductions than the lower and middle income classes when it comes to charitable contributions. The charitable tax deduction is based on an individual's or couple's peak ordinary income tax bracket. Thus, millionaires effectively receive a deduction of 0.396% for every $1 they donate to charity, since the peak marginal tax rate is 39.6%. Comparatively, low and middle income Americans are likely to receive just 10 cents, 15 cents, or 25 cents on every $1 they donate. One thing to remember is that you'll want to ensure that your donation is documented and headed to an eligible charity. If the charity isn't a federally recognized nonprofit organization, or you need documentation to back up your contribution, it won't help reduce your tax liability. Number 8. Business expenses. You could deduct necessary business expenses commonly accepted in your trade or business. For example, if you run a store, you can deduct the cost of goods sold from your federal taxes. Or if you're a freelancer, you can deduct expenses related to your business website. This is something that wealthy businesses owners and might do to reduce their tax burden. Again, it would help if you had a business income to take advantage of this tax savings opportunity. The best tax software can help you identify deductions for your business if you run your own company. The best business credit cards could also make it simpler to track your business expenses at tax time. Number 7. Hire your kids. Entrepreneurs that make their business a family affair will benefit financially. For instance, hiring your children may provide tax advantages. According to the IRS, no Social Security or Medicare taxes are owed to the wages received by a kid under the age of 18 who works for their parents in a sole or partnership in which each partner is a parent of the child. It may also aid in reducing taxable profits. In order to help with hotel projects in Hawaii and Vancouver, British Columbia for instance, Trump employed an anonymous consultant. As a result, being able to deduct these consulting fees as a business expense, Trump was able to pay less in taxes overall by reducing the amount of the final profit that was liable to tax. Number 6. Increasing equity exposure and managing gains. The reason why the wealthy choose to invest in stocks is that if the equity is kept for longer than a year, the taxes on the sale are often lower than the rates on wage income. Additionally, they can afford to take higher risks. Target dates and low-risk funds sometimes make sense, according to Carson, who noted that many people with higher net worth also have higher risk tolerance preferences and abilities. The federal wage tax rates range from 10% for the lowest earning to 37% for the richest. The federal tax band you are in also affects the short-term capital gains taxes you pay on equities you have owned for less than a year. Feather & Gill noted that the wealthy also attempt to manage these financial gains and losses in a way that minimizes their tax liability. For instance, people often try to take losses near the end of the year to balance out some of the gains that they made earlier in the year, which causes a flurry of activity to occur. Before we move on, please support us by hitting subscribe and the bell icon to get notified when we post new videos. Now, let's get back to our topic. Number 5. Roll forward business losses. To the New York Times, during the years 2008 and 2009, Trump declared losses from this core businesses of $1.4 billion. In the future, Trump may obtain a $72.9 million tax return by carrying forward these losses. It's a little difficult to understand exactly how this works. Net operating losses are another name for business losses, according to Philip Erb's Forbes essay. When your tax deductions are more than your taxable income, an NOL typically arises. It doesn't seem fair if that amount is negative in one year but positive in another, resulting in tax due. To correct this injustice, there is the NOL. In other words, by using the loss from the 1 year to offset your taxable income, you can pay less in taxes next year. Number 4. Estate and gift exemptions. There is now even greater justification to use gift and estate tax deductions to reduce taxable income. The deductions have temporarily been doubled as a result of the recent tax law. Individuals can now claim up to $11.18 million, up from 2017 cap of $5.29 million. According to Feather & Grill, the wealthy are taking advantage of the exemption because it will expire at the end of 2025. As an example of a long-term trust that enables money to be passed down from generation to generation, she mentioned Delaware Dynasty Trusts. Even if it is a subject to income taxes along the way, if it meets the limit, it will not be taxed as a gift and won't be liable to estate tax when the money is distributed. However, according to Featherman Gill, it only makes sense when you have $5 million or more to commit, considering the costs associated with establishing and maintaining a multi-generational trust. Number 3. Investment income. Millionaires often have investment and earned income, which might provide certain federal tax benefits. If you purchase investment assets and make money from them, you are eligible to benefit from these tax breaks. In addition, investment income can have a relatively low capital gains tax rate, provided you hold the investment for over a year. The capital gains tax rate ranges from 0 to 15 to 20% depending on your income and tax filing status. You will be subject to taxation at the short-term capital gains tax rate, which is equal to your regular income tax rate if you do not possess your investments for more than a year. This can rate up to 37% depending on your tax bracket. Number 2. Buy health insurance. Health insurance may not immediately come to mind when you're thinking about tax planning, but being covered has 2 significant benefits for millionaires. To begin with, health insurance is mandated in the United States via the Affordable Care Act's mandate. If you don't buy health insurance, you could face a penalty known as a Shared Responsibility Payment or SRP. No health insurance will likely result in an SRP of $2,500 or higher for top income earners. Secondly, medical bills are the leading cause of bankruptcy in the United States. Finally, health insurance could provide the financial protection you need if an unexpected and costly illness or accident arises. Number 1. Trusts. Trusts are vital if you're trying to determine how to avoid inheritance or estate tax. It's possible to create an irrevocable trust and transfer assets into it. The trust becomes the owner of the assets, and the person who made the trust can make their heirs as their beneficiaries when they die. Because the investments don't pass through the probate and aren't inherited in the traditional sense, no estate or inheritance tax is owed. Anyone could take advantage of this, but creating a trust can be expensive and involves giving up some control over the property. It's also necessary for most people because only a few states charge inheritance tax. And for the tax year 2023, estate tax at the federal level is only charged once the state is valued at $12.6 million or higher. So that's it. Please like, share, and comment below if you like this video. Remember to subscribe to see our next video. Stay safe, and we will be back soon with another video.